Savings and investment options. What is the difference between saving and investing money? When you save, you put money away in complete safety and get it all back plus interest. When you invest, you risk losing some interest and or principal for the chance it will grow quicker. Over the long term, investing usually outperforms savings. Unfortunately, as investing comes with a risk, this is not guaranteed. Get it wrong, or even just get the timing wrong, and you could end up with less than you started with. While the returns on savings are relatively low, the main benefits from a savings account are safety and accessibility. What are the options available for savings? We have some checking accounts that bear interest, so they are a type of savings account. We have the basic bank savings account. We have the online savings account. These are savings accounts that can only be established and operated online through electronic transfers. They usually bear a higher interest rate compared to the basic savings account. There is the money market account. This is a hybrid between a checking and savings account that allows you to issue a limited number of checks each month. The advantage is that your money will earn a higher interest rate than it will in a checking or savings account. However, there must be a stipulated minimum balance on the account to avoid a monthly service charge. There are also the credit unions. These are financial cooperatives owned and controlled by its members, something like the Isusu and the staff unions of big organizations. A lot of times, they are established to serve anyone that lives, works, worships, or attends school in a particular geographic area. They offer higher interest rates on deposits than banks. Before opening a savings account, it's a good idea to figure out how you'll be using it. You need to ask yourself how long you'll be keeping your money in the account, how often you would want to withdraw money, how much money you would keep in the account. All these facts can have an impact on how much interest you can earn. A simple rule to keep in mind is that time is money. The longer you're willing to leave your money alone in an account, the higher interest you are likely to earn. What is investment? The word investment can be defined in many ways according to different theories and principles. Generally, investment is the application of money for earning more money. In an economic sense, an investment is the purchase of goods that are not consumed today but are used in the future to create wealth. In finance, an investment is a monetary asset purchased with the idea that the asset will provide income in the future or it will appreciate and be sold at a higher price. One of the hardest things to figure out is, where do I invest my money? The answer to this question depends on what your aim of investing is and the options available to you in your environment. Let us consider some common and easily available options. The first one is the money market. This is not a physical market that is situated anywhere. It's a platform for short-term investment with a tenor less than or equal to 365 days. Money market investment options include fixed deposits, which are made with banks, and they offer interest rates higher than a savings account. They are usually made for a specific period like 30, 60, or 90 days, The tenure can be up to 1 year. The principal amount and interest are returned to the investor at the end of the period. We also have treasury bills. These are instruments issued by the central government. So in Nigeria, they are instruments issued by the federal government of Nigeria for periods of 91, 182, or 364 days. They offer a better interest rate than fixed deposits, and they carry a no default risk because the government will always pay its obligations. We have commercial papers and bankers' acceptances. These are instruments that are usually arranged through banks and some other financial institutions. They are securities issued by big companies to borrow money from the public. The commercial paper has a maximum tenor of 270 days and is an unsecured instrument issued by blue chip companies. The banker's acceptance has a maximum tenor of 180 days and carries the guarantee of the issuing bank. We also have mutual funds. A mutual fund is a pool of investment fund contributed by many investors and is usually open-ended. This means that you can always join the fund or leave at any time. It is professionally managed by qualified investment experts. The fund is used to purchase different types of securities, and the income received is distributed to the investors. All these instruments are money market instruments. Another investment avenue is the capital market. The capital market is a financial market for selling and buying long-term investment instruments. It can be conducted in a physical location or through dedicated trading systems. In Nigeria, we have the Nigerian Stock Exchange with a physical location which also operates a dedicated trading system that stockbrokers can use to link up with the market. That is, they use the dedicated system to link up with the stock exchange and conduct their trade. Capital market instruments include long-term debt instruments like bonds and then equity-backed instruments, which we call shares. Bonds are issued by corporate bodies or governments, and they carry a fixed interest rate with interest payable yearly or half yearly. Shares entitle the investor to be a part owner of the company. You make money from shares through dividend and capital appreciation. We also have the Forex and commodities market. These are organized and over-the-counter markets. While the Forex market trades in international currencies like dollars, euros, pound sterling, and yen, the commodities market trade in goods such as coffee, cocoa, and mined products like gold and oil. The investor makes money by taking a position and then selling at a higher price. Another investment avenue is private equity. This is composed of funds and investors that directly invest in private companies, companies that are not listed on a public exchange, or that engage in buyouts of public companies, resulting in the delisting of these companies from the public exchange. We also have real estate. Real estate investment involves the purchase, ownership, management, rental and or sale of real estate for profit. It is the best type of investment that provides a hedge against inflation vis-à-vis the risk. In an inflationary environment, as prices rise, the value of the real estate investment will also increase. However, it is a high maintenance investment that requires a lot of effort and hands-on. The last but not the least is starting a business. Investing money in a startup is an ultra-risky venture that can also give the highest level of returns possible. However, it is not everyone that is cut out for this type of investment. Risk and return go hand in hand in investment. So it is important to consider your risk appetite before making an investment. Investment channels. If you want to invest in the money market, you talk to professionals in the banks and in other financial institutions. If you want to invest in the capital market, you talk to stockbrokers and you interact with the stock exchange. To invest in real estate, you talk to estate managers and property development companies. To invest in foreign currencies, you would need to interact with bankers and parallel market dealers. Investing in private equity would require you to go through a private equity firm, or the opportunities may come through friends and family. Investment involves capital or cash outlay. It involves expectation of interest or profit. It involves the risk of losing value. It also involves investment instruments such as shares, bonds, or land. Based on the above, you cannot go into investment unless you have funds to invest. These are funds that you would have built over the years through savings. If you're already an investor, you need to continue to acquire more knowledge. Do not invest in an area where you know nothing. Investment principles. The most important principle in investment is that you must diversify your investment. Do not put all your eggs in one basket. Spread your fund across different classes of investment. The effect of this is that your risks are not concentrated and therefore minimized. 2 books, The Richest Man in Babylon by George Clason and 5 Rituals of Wealth by Todd Bernhardt, are resources that can enlighten you further on investment. The principles of investment discussed in these books are summarized as follows. The Richest Man in Babylon. Start by saving 10% of your earnings. Control your expenditures. Reinvest the returns on your investment. Protect your principal. Security of principal is very important. Have your own house and make it a profitable investment too. Prepare for your future by investing in an area that will produce income for your old age. Do not relent. Continue your ability to earn. 5 Rituals of Wealth. Save 10% of your earnings. Seek your own dream investment where you wish to multiply your wealth. Have an effective investment plan. Invest your earnings in your pet project. Give 10% of your returns on your investment to God. The author, Todd Bernhardt, was a cleaner in England who became a millionaire at the age of 27. He was asked to give a strategy, and he gave the above in his biography titled 5 Rituals of Wealth. In summary, For you to be successful at managing your finances and making appropriate investments towards living a comfortable life at retirement, you need to do the following things. Identify your subconscious beliefs about money and work at making them positive. Understand and control your current financial situation. Set financial goals and create a plan that will help you achieve them. Prepare a budget that represents the financial equivalent of your plans. Stick to your budget. Avoid random spending. Review the budget often. Make saving and investment a passion. It is the only way to acquire wealth. Thank you for listening.